We have already discussed short straddle and iron fly. So now we are coming to another strategy called short strangle. I can tell you there are only 3 strategies which are very, very popular. One is short straddle. Of course, with the limited risk, it becomes iron fly. Second one is short strangle. With a limited risk, you buy both call and put, that becomes iron condor. And the third one is a ratio spread. So these are the 3 most popular strategies and people use. So now we are coming to our second strategy, which is a short strangle. So for those who are not very sure what is short strangle, let us say market is trading around 9,000, then maybe 500 point up and 500 point down, you are selling a call option and put option, that is called short strangle. So short straddle is selling the call and put at the same strike, but short strangle is selling the call on the higher side, selling the put at the lower side. So let us say 8,500 put option and 9,500 call option. So this is an example, right? So selling for out of the money, put option and call option at the same time. So that is called short strangle. And what normally people do, some people tell me, sir, I am a technical analyst, sir. I know 8,000 is the support, 10,000 is the resistance. Then I tell them, okay, if you think 8,000 is the support, you sell 8,000 put option. And 10,000 is the resistance, you sell call option at 10,000. Some people go by the open interest. Sir, 9,000 open interest as the 9,000 put option as the highest open interest, sir. 10,000 call option as the highest open interest among the call options, sir. So the support is 9,000 on the downside, 10,000 on the upside. Then you go and sell 9,000 put and 10,000 call. So I also look more open interest. And but to me, looking at open interest is not the big deal, because most of the time I contribute more for the open interest. Just for fun, I used to tell my friends, I don't look at the open interest, I create open interest. So identify the support and sell put option, identify resistance and sell a call option, and keep at least 400 point away. And the reason which I already discussed in the short straddle, from 2008 to 2020, leaving the 2 incidences of Lehman Brothers collapse and coronavirus, in all other cases, the Nifty gap down maximum of 400 point. So at least keep 400 point away. And then long-term options is also a good idea. So because the last few months, the least the Nifty went is 7,500. And you can see even 7,000 put option, 6,000 put options are trading actively in December contract. And I sold even 5,000 put option for 300 rupees. So you can sell 7,000 put option and 12,000 call option also. You can keep such a wide margin and you can do it. And I think I already told you, and I'll tell you once again, Warren Buffett trades in these long-term options, typically expiring 5 year to 10 year, and far out of the money put options he sells. So that is also possible. And so long-term strangle is also a good idea. Okay, right. Now, once again, because of this margin benefit, so don't ever do the short strangle. Whenever you sell a call option, 200 or 300 point higher, you buy a call option. And wherever you are selling a put option, 200 or 300 point down, you buy a put option. So when you do, that becomes iron condor. So first we discuss short straddle. So the short straddle is unlimited risk. And then you buy a call option and put option. I told you that becomes iron fly. That iron fly is a limited risk. So the same way, now we discussed short strangle, and if you do buy one call option and one put option to convert it into limited risk strategy, so that is called iron condor. And people, many of you are from US, and I'm sure you must be trading in US markets. So in US markets, so iron condor is a very, very famous instrument most of the people trade. And because in US, most of the brokers do not allow you to take a naked positions, especially if your account size is small. So you have to take a hedged position only. So now in India also, that is also happening now. The people will like to take only hedged position, right? So we have covered short straddle, iron fly, short strangle, and iron condor, right? Now we will discuss more about this short strangle. Now, short strangle, I can tell you, this is the most dangerous strategy in a trending market. But 95% of the people, option selling means they think short strangle only. And they think short strangle is a more safe strategy than the short straddle. So let me clarify a few things. Why people think short strangle is safe? Because you are selling far out of the money, right? So one of my friends, he has a very big capital and he used to sell far out of the money, call option only, because he was having a considerable portfolio running into 100 crore. So he doesn't like to sell put option. He used to sell only call option, far out of the money call option. He used to sell the call option only for 1 rupee. But still, because his capital, the cash market underlying is over 100 crore, he used to get 100 crore limit from the broker. So when he sell a call option, he used to get about 7 to 8 lakh rupees every week by selling at 1 rupee. And what happened? The things was going on very nicely. Every week he was getting about 8 lakh rupees and it was going very well for nearly 1 year. Right? But one day that Nirmala candle came. So that 1 rupee call option went to 78 rupees. So whatever he made profit in the last 1 hour, 1 year, and everything was wiped out, and on top of it he made some losses also. So always remember, you are selling a call option far away or you are selling a put option far away, you don't think that you are safe. The probability is less, but the loss can be very huge. Your 1 rupee can go to 100 rupees. You can lose 100 times. Short straddle, to me, is more better than the short strangle. You know why? Short strangle, you sell far out of the money call option and put option, let us say for 20 rupees, your maximum profit is only 40 rupees only, if you are correct. But in short straddle, at the money call option and put option you sell for 300, 600 rupees. If the market somehow, it closes around the same level after 1 month, you can make 500, 600 rupees profit. So there is an element of luck in short straddle, which is not there in short strangle, right? So therefore, generally I do not advise people to go for a short strangle. Even people like James Cartier, Nick Leeson, so they have lost billions of dollars. James Cartier was not billions, it was in millions only. But they all have done the short strangle only, right? So here, the 2 key points is that, 1, you don't go for naked short strangle, always go for iron condor. And even otherwise, short strangle is not a very good strategy, but however, with some modifications, you can make it a very good strategy. So what modification you can do? Let us say market is at 9,500. And what people do, they go and sell 9,000 put option and 10,000 call option. So this is what generally people do, and that is called short strangle. But whenever people come to me, I advise them to do it slightly differently. So let us say you have got money for 3 lots of call and 3 lots of put. And don't sell 9,000 put and 10,000 call. Here 3 lots, here 3 lots. Don't do like that. So what you do, you sell 10,000 call, then sell 10,100 call, then sell 10,200 call. The same way, sell 9,000 put, 8,900 put, and 8,800 put. So you spread it. So we call this as multiple short strangle. So what is the advantage? You are spreading the risk. Let us say market moves violently, right? If it touches 10,000, so you may have to do martingale only for 1 lot. And if you do 3 lots of call and 3 lots of put, then you have to do martingale for 3 lots. For doing a martingale of 3 lots, you need 6 margins. But here at any point in time, instead of 3 lots, only 1 lot will be in trouble. So you can do martingale for 1 lot, and that will be easier to manage. So if you have got a good capital, and of course now the margins are going to be very less, and whatever capital you have, you can do multiple lots. So that is not an issue. So instead of doing a short strangle, so you always go for multiple short strangle. So that is number 1. Number 2, let us say you got money for 30 lots of call option and 30 lots of put option. So what you do 10 lots here, 10 lots here, and 10 lots here, and 10 lots here, 10 lots here, and 10 lots here. Selling 10 lots of 9,000 put, 8,9 put, 8,8 put, selling 10 lots of 10,000 call, 10,100 call, 10,200 call, right? And if you are doing like this, then maybe just 2 lots. So you buy 9,600 or 9,700 call option. Similarly, just buy 2 lots of 9,300 or 9,200 put option. Some small quantity. You don't have to do the same level, but you can some small quantity. So why this is required? When markets move violently, right? Market may not go above 10,000 or market may not go below 9,000. But if the market make a 200, 300 point violent move, okay, let us say market moving violently on the downside. The call option premium may not come down very much, but put option premiums may shoot up due to the volatility, and therefore you will see the MTM loss in your trading terminal, so you will be psychologically affected. But for some small quantity, you do buying of option, and then what happens, even if the markets move violently, the MTM loss may not be very big because this buy option will give you some profit. And of course, now because you have to buy same number of lots as you are selling to get the margin benefit, now the system should work like this. You sold 30 lots, but 2 lots only you bought the put option. The remaining 28 lots you have to buy maybe 10,500 call option. Or you can buy it in weekly. The same way, 2 2 lots you buy 9,300. So the remaining 28 lots you have to buy at 8,500 put option, either monthly or weekly. So hopefully this will, first thing is that you get the margin benefit because 30 lots sold and 30 lots bought. So margin money will be less. And second thing, if the markets move violently, this will give you the profit first. And then only the loss will happen. And then anyway, too much violent move. So this 28 lots buy will give you some cushion. Okay. So always have something like this. Learning point here, don't do naked short strangle and always go for iron condor. So what is the difference between short strangle and iron condor? In iron condor, you buy same number of lots as you sold. Okay, and that buying, it is not necessarily buying should happen far out of the money, but few lots you can do it at the front also. Okay, I used to explain this just by telling a story. So let us say you are the king in a country and I am also a king in my country. Right. So you decided to launch a war. So I have 50,000 soldiers with me. So if I send all the 50,000 soldiers in one group, in case your army overpowers our army, and if all the 50,000 soldiers die, then the probability of winning the war is very, very, very remote. So I am not supposed to send all the 50,000 soldiers in one bunch. So what I will do, 10,000 soldiers, then I'll give a some gap of 500 meters or 1 kilometer, another 10,000 soldiers, again give gap, another 10,000 soldiers. So I will be putting them in 5 different batches. So that, even if your army kills the 10,000 soldiers, the remaining 40,000 soldiers will be there to support me. So it is not a good idea to send all the 50,000 soldiers in one go. So that is what we are doing here. We are not selling all the 30 lots at one strike price. We spread the risk. Just like we spread the risk in the battlefield, we are spreading the risk here. This is the first thing. Second thing, before the war, during the normal course, some of your citizens would have crossed into my country. I would have arrested them. I would have put them in my jail. So when you decided to launch a war against me, so what I will do, I will be putting my 50,000 soldiers into 5 batches, 10,000, 10,000, 10,000, 10,000. For the first 10,000 soldiers, what I will tell them, okay, take all those prisoners and you put in front of you as a human shield for you. So that if enemy attacks, the first one die should be their own citizens. Then only we should die. So this is a war technique, keeping the enemy's citizens as the human shield. So the same way, so that is what here exactly we are doing. If the market moves violently, the market should give us profit first in the buy option, then only the loss should come in the sell option. Of course, we cannot afford to do the same lots, because if you do same lots, then there is no point, right? So this is the difference. I told you every strategy we make some difference, and this is the difference that we make. So we don't do normal short strangle. So we do short strangle with a buy option far out of the money for protection, convert them into iron condor. But we don't do strictly like that. We do some buying in the front end also. And then we don't sell at one particular strike price. So we spread the risk by 2 or 3 strike prices, right? So this is one. Okay, now I have not back tested it. So I was told by one of my followers, People normally tend to sell far out of the options. And people always think, you sell far out of the option, so you are more safe. But actually that is not true. The reason is that when the markets are in sideways mode, okay, you get only 10-20 rupees profit. But when the market is trending, your loss is very big. So, therefore, I will not suggest you to sell, very, very far out of the money. And you are not going to make any significant profit. But when there is a loss, you are going to make a huge loss. So, therefore, what normally we suggest, let us say market is trading around 9,500. You just take only 200 point higher. So you sell 9.7 call, 9.8 call, and 9.9 call. Then buy 10,200 call. So sell one lot, sell one lot, sell one lot, buy 3 lot. Same at downside, you sell 9.3, 9.2, 9.1. Then 3 lots you sell 8.8. All these are put options. Okay, we started with plus 200, minus 200. But again, this is not the standard rule. You do this plus 200, minus 200 only when the volatility is very, very, very low. Sometimes the volatility is very high, you go 300 or 400 point. You depend on the volatility. Right now the volatility is somewhere around 30. India VIX is somewhere around 30. Then you can go for 300 or 400. So 200 is only when the volatility index is below 20. So this is nothing but multiple short strangle with protection both upside and downside. But instead of selling far out, so we are doing closer to each other. But the moment you do closer to each other, if the market goes sideways, you are going to make fantastic profit because you are collecting huge premium. The nearer you are selling, the premium will be very high. But the markets will move either side. So in that case, what you need to do, if the market is not moving plus or minus 200, if the market not moving plus or minus 200, so you just wait, don't do anything. The moment market moves 200 point, let us say it moves 200 point plus, market is coming to 9,700. Let us say market is coming to 9,700. Let us say market is coming to 9,700. So what you do, the entire thing you shift by 200 point. So which means you close this, and now you should sell 9,900, 10,000, 10,100. Call option. So you no need to square up this because this will be there. You have to square up these two, then you have to create these two. And this 10,200 can be shifted to 10,400. So which means the entire thing you are shifting for 200 point. The same way this also you have to shift everything, entire. That means this should look like 9.5, 9.4, 9.3. But 9.3 is already there. So that means you have to square up these two and you have to take these two. And then the buy option also you have to square up and you have to do buy option at 9,000. So which means you take a multiple short strangle, not very far away, nearer, then 200 or 300 point higher or lower, you have to buy for the protection. So one is that you are safeguarding yourself from black swan event, and second one you get the margin benefit. And then after that what you do, first time you wait for the market to move 200 point up or down, and then once you move, then you have to shift everything. Everything you have to shift 200 points. First time. Second time onwards, you have to start shifting everything for every 100 point. Sometimes shifting happens on the higher side, sometimes shifting happens on the lower side. Why we say you have to do this strategy only when the market is having less volatile? Because in high volatile market, every day they move 200, 300 points. So you cannot be shifting every day. So that is why when the markets is highly volatile, you don't start with plus 200, minus 200. Maybe you can start with plus 500, minus 500. And still you will get a very huge premium. So the idea is to collect more premium so that in case market goes sideways and you get a huge profit. And look at the May series. May series was one of the worst volatile, huge moves every day. Every day Nifty moved 200 points. But month to month, it has closed almost flat. The May series started around 9533 and ended at 9490. So month beginning, starting, and month end, closing, it was just 35, 45 points down. But the market moved every day 200, 300 points. So that's why if you have kept 500 point distance, and you would have made very good profit. So this is multiple short strangle with protection and with keep on moving the positions. So very simple. If you are already working somewhere and you want to have a passive, then you don't do this. But if you are a full-time trader, and you have enough time for adjustments and you can be very active, you can do this. So this will give you higher risk and higher reward. And passive strategies will give low risk and low reward. So this is one strategy. I can tell you, you keep doing this strategy for many years and I'm sure you will be able to get at least 4 to 5% return per month, and which is a fantastic return. And because now the margins money is very, very less, so you can hope to generate much better return on investment, right? Okay, so okay, I just summarize what we have discussed already. So we have done introduction, and then we have done straddle, then we have done iron fly, then we have strangle, then we have done multiple strangle, then we have done iron condor. And here straddle, strangle, multiple strangle, all are unlimited risk strategy. And here iron fly and iron condor, they become limited risk strategy. So these are the strategies. In addition to the strategy, firefighting techniques. What are the firefighting techniques we have seen? Firefighting techniques we have seen shifting, averaging, extension, reference rate, pyramid, martingale, and exit. So far, we have seen about 5 strategies and 7 firefighting skills. So now we will go back to Zoom software for question and answer. So after that, we will come back. We will go for the next strategy, which is called ratio spread.